So the stock market is selling off, and everybody around you, left and right, your Uber driver, anybody on the internet, they're saying investing into stocks is the worst idea possible. I mean, for crying out loud, if you look at any headline from Wall Street Journal, The Economist, New York Times, things look pretty bad right now. And then according to the Fear and Greed Index, what emotion is driving the market right now? 11 out of 100, extreme fear. The funny thing about all of this is the narrative and the reason changes, but the conclusion is always the same from these folks. This time it's going to be different. It's all over. The stock market as we know it will never be the same, and you're going to lose all your money. They said the exact same thing in the year 2000, 2008 to 2009, 2020, and then again in April 2025. But if you zoom out and take a look at the S&P 500, otherwise referred to as the market, just look at the history, the data, the timeline. Every single time there's a big sell-off, a big correction, a big drop-off, a big panic selling, big whatever catastrophic event, time and time again, the stock market as a whole, it recovers and it moves on to new all-time highs. The thing is, when it comes to the stock market, it doesn't always go up. Not every single year is going to be a bull market. Take a look at the total return broken down on an annualized basis. Overwhelmingly, the stock market tends to go up year over year, but as depicted by the red bars right here, sometimes it does go down. Like during the Great Depression, it dropped by almost 45%. And then during the Great Financial Recession, I think that's like a ballpark of, what would you say, like 38%. And then during the pandemic sell-off, we were roughly 19-20%. But over the grand scheme of things, if you blend the data and average it out, the S&P 500's CAGR year over year, the performance is roughly 10%, which means for those of you that are allergic to math, sometimes the stock market might go up 22%, sometimes it might only go up 8%, and then other times it might go down by, as evidenced by the red bars, 25%, 40%. It doesn't always go up. So my whole thing is, if you are an investor of stocks and you thought that everything was way too expensive when we were at the top, everyone's trading multiple was like a 30, a 40, or a 50, why not buy into them right now? Like, that's my mentality and perspective, because these high quality compounders, dude, they're finally on clearance. It's like going to Costco, and let's say that you were going to go ahead and buy some beef brisket, but you go to the meat rack and now they're 40% off. Like, wouldn't you be happier? Like, dang, I was going to buy it already, but now it's 40, 50, 60, 70% off. Why not? Thank you. And I already know what someone's going to say. Oh, it's going to get worse. It's going to sell off even more. But the thing is, nobody can predict when the bottom is going to be, like when it's done selling off and when it's going to start to rebound and rally. That's why I'm just buying as it continues to sell off. I'm not going to be correct on when the bottom's going to be. But as I keep buying and acquiring shares of high quality compounders as they're going on a dip, you zoom out, just like how here, like this chart right here, you zoom out 5, 10, 20 years down the road, this 20%, 30% correction that we're about to experience, it's going to be nothing. So the fact that I'm able to buy equities and stocks and ETFs that were on my watch list for years, because now they're finally getting to a reasonable valuation, I'm going to buy. I'm not trying to tell anyone else what to do. I'm just saying what I'm doing, right? And you can watch, laugh, call me an idiot, whatever you want. I'm just telling you what I'm doing, right? I'm documenting the progress of my journey, so yeah. But it's really important to keep in mind, and I do want to emphasize this point, not all equities are going to survive if we truly go into a recession or even a depression. So those speculative, hype-driven companies, the ones where the narrative just makes them explode in valuation, even though their balance sheet, cash flow statement, and P&L look like booty hole, they might go belly up. And we saw that happen even 6 years ago during the 2020 pandemic sell-off. A lot of those speculative companies, they're delisted. They no longer exist as an organization because they were just all smoke and mirrors. If their P&L, their profit and loss, the income statement, if the company in question is not generating real cash profits from their product or service, and to take it a step further, if they're not profitable and they're not flush in cash, right now, dude, they might be doomed. However, when we start talking about SPY SCHD, DGRO, VU, VTI, some of these high quality ETFs, you're going to be fine. Reason being is that it covers the entire market or a specific index that, for the most part, their holdings and the companies that make up the index, they're good enough where eventually with due time, they'll recover. Obviously, past performance is not indicative of future gains, but dude, if we're going to be talking about Costco, Berkshire Hathaway, Microsoft, Amazon, MasterCard, Visa, you really think these companies are going to go belly up and disappear overnight? Get real with me, please. However, something that I am keeping in mind is that as I am shopping in the clearance aisle right now, picking and choosing individual stocks, it's going to come with a risk to reward trade-off. But like I just said, broad index funds like SCHD or VU, they diversify away the ugly losers with the beautiful winners. So your CAGR should be in the ballpark of 10 to 13%, like not the highest, but at least it's better than a high yield savings account, right? But with individual stocks, the reason why I'm going towards that direction is the potential upside of like 20, 30%. Once the sell-off is over and we stabilize and then we trickle back on up to recovering and rallying back. Obviously, that's going to take some time because of the whole Middle East debacle, inflation, the tariff circumstance that's hurting everyone's bottom line. But apparently refunds might be on the menu. And then, of course, questionable GDP growth. All of that, yes, they're real and I'm not denying it. I'm not delusional. I think we are going to experience more red days and pain ahead because that's a lot. And that's why, even though I don't know what's to come in the future, that's why I am going to prioritize and focus on dividend compounders with cheese. Growth-oriented stocks that also happen to pay a dividend. Because if we go into an extended bear market, where our equities and our portfolios are going to be in the red 6 months down the road or even like 18 months down the road, the passive income and cash flow pouring in from those dividend compounders, it's going to help to reduce the pain. So that's basically what I'm going to be doing. I know there's a lot of fear, uncertainty, and doubt, and there's people throwing up content saying it's all over with flames in the background, saying this time it's going to be different. That's what they always say. Right, so I'm going to put my money where my mouth is. Don't copy me. You can watch and learn from my mistakes. Maybe 10 years down the road, this was the right decision. Or I'll give you guys an update and this can be the biggest mistake of my life. So you have my word. I'm going to continue to dollar cost average and buy stocks.